Okay, guys, so welcome to my guidance session for AAA. So, this is something that I'm conducting after a very long time. It's been 3 years. Uh, we've now started with AAA coaching as well. And as I said, we are going to discuss whatever I can discuss, which can help you in this 1 day free session, which will be uploaded on YouTube. So if you guys are not able to attend this session fully live, I highly recommend all of the participants which are here today. I recommend that you do watch it live. Reason that just not create any backlog. Okay, so if you are already preparing for AAA, I'm sure you are enrolled somewhere, you must be having your lectures backlog already, so don't put this one also under that backlog pressure. So I highly recommend that you guys watch it live only and get it done and dusted with it today itself. But the students would be watching it on YouTube as a recording. They are also welcome to the session. So today I'm going to discuss with you the tips and tricks to pass AAA, together with one question practice, which I will do from our very recent past paper, that is December 2023 past paper, question number 1, which is for 50 marks. So I'll be discussing with you all of that related to AAA. But before I start, I want to know what impression do you have of this exam? If you guys have been my students at any point in time, maybe on YouTube for SBR, so I always make SBR easy for you. I always try to make sure that you're not afraid of that paper. You don't feel like what's this exam all about. So I want to ask you, are you afraid of this AAA? Are we afraid of AAA? What do you believe that is this paper very difficult, manageable? What's your thought process till date? What do you think about AAA? Low pass percentage, very difficult. Low pass percentage. It is a tough paper, difficult to pass. Horrible. Difficult. Horrible. Okay. Lengthy paper. So before I begin with it, you might not be knowing that why am I taking up this paper, because when I was in ACCA, like I was doing ACCA, I'm still in ACCA. So while I was doing ACCA, I've given this paper, and my first teaching journey began with AAA only. My first class ever that I took was of advanced audit and assurance only. So I'm not saying that I have an experience of 3 years or 4 years of teaching this paper. No, I'm telling you honestly, I was on a break for this paper for the 3 years. I taught it 1 year, then I had a break of 3 years, and now I've resumed it. So bear with me on that. But I make sure that I try to make this paper easy for you. So if you believe that this paper is horrible, maybe something is going wrong with your preparation, or you have heard lots of things about this paper from your peers, and you are not able to totally grasp this paper, because if you guys were good in SBR, I really believe if you guys were good in SBR, you would be good in this paper as well. The reason is that audit and IFRSs are very much linked. I'm not talking about the theoretical areas where I talk about laws and regulations, fraud, money laundering, or where I talk about ethics. I'm not talking about those areas. I'm talking about the major syllabus area, which is completion of audit, planning of audit. These two syllabus areas where we talk about evidence, procedures, risk, these three areas are completely taken from SBR. It's like just like the treatment, the standard, you'll be able to develop a procedure or an evidence out of it, or you'll be able to develop a risk out of it. So I'll try my level best that I make sure that you guys are not afraid for this paper. You're not afraid about this paper, and rest, it's on to your preparation, how much you're practicing, whether you'll pass or not. That's something that you will determine with your hard work. But I am doing my job. I'll give you the best level of guidance which I can give in this particular session. So without any further delay, let's get started. I'll take your doubts towards the end. So I request you to keep the doubts a little later. So let's start. Whatever I will be writing on the board today, board means this word file, whatever I will be writing on the board today, you are going to get a PDF of it, okay? So if you want to get the PDF for this, I request you that kindly put a message on my WhatsApp. You all know my WhatsApp number because you've joined it, but I'm just writing just in case you do not. So 9877 637809. You need to put a WhatsApp DM on this number. You'll automatically get the WhatsApp group link for AAA, and you're supposed to join that group to get access to all the notes that I provide, all the Word files. So this Word file will be provided on the WhatsApp group itself, right? So let's get started. Let's see what do we have for today. Okay. Yeah. So first of all, guys, this AAA paper, what does it consist? What does it consist of? It consists of three questions, question 1, question 2, and question 3. Question number 1 is about planning stage of audit, majorly about planning stage of audit. And I'll also talk about the recent changes in AAA. I don't know why students have created so much fuss about it, the change in materiality. What's the change in materiality? Is it too difficult change in materiality? They're simply giving you, they made your work easier. They're giving you that we base our materiality on this particular threshold. So that's what I have to keep in my mind while solving the question. So that becomes very easy. So in the planning stage of audit, I'm going to discuss about what do we have? We have business risk. We might be asked a question about business risk. And then we might be asked a question on ROMM, risk of material misstatement. This ROMM is basically when I talk about all the risks apart from detection risk. So when I remove that detection risk, right? So that is ROMM. Then we have audit risk. Yes. So we have to point out the risks in the case study. But how many of you know that this time we have 20 professional marks? Like not this time, since long this has happened. In SBR, it was not there. So that means you might not be aware of this if you're giving this paper for the first time. That in AAA, you have 20 professional marks. Now, many students cry about this also. Ma'am, 20 professional marks, what to do? 20 professional marks means 20 professional marks means that 80 marks will be technical knowledge and 20 marks will be professional knowledge. So whatever you've written, the examiner is going to test you twice on that. So if I have written a business risk answer, the examiner will first view it from technical point of view, that whether what I'm writing is technically correct or not. As per the ISAs or as per the IFRS, whatever I'm applying, is it technically correct or not? Then for the 20 professional marks, he'll again view my answers and he will see whether I've applied the analysis skill really well, evaluation skill really well, whether my communication is correct or not. And then he will also see whether I have commercial acumen. So all these things come into 20 professional marks. So when you are making what is the difference between SBR answers and AAA answers? In SBR, I used to teach you 1 mark, 1 point. So you can write in bullet forms. But when I talk about AAA, here that's not the case. Because here you're getting 20 freaking professional marks. So can you imagine 20 marks, 20%? That's a huge deal. So that is basically just for my professionalism. So this means I have to make sure that whatever I write in my exam is not just technically correct, but is well presented, well communicated, well articulated. Articulated means the terminology that you're using, the keywords that you're using. See, you are going to communicate in the AAA paper, you're communicating with whom? Most of the times, to whom are you writing the emails or from whom do you receive the email and you give a briefing note? To whom do you report? Yes. To whom do you report? Audit engagement partner. Who's an engagement partner? Is engagement partner your friend? Is engagement partner someone very normal kind of a person? He is a very senior level person with a senior authority. He has knowledge, he has experience, he's been working in the industry since so long. And when you communicate with such a person, when you communicate with such authority, you're supposed to maintain communication skills. You're supposed to maintain good language, posh language. You know, if you have ever been in contact with any such authority or any such person who's at a great level, they speak less, they convey more. I don't know if you have experienced this or not. They would speak less, but in whatever they're speaking or they're writing, what they're conveying is of next level. It's having a deep meaning, A. B, what they're conveying is well articulated. This is known as very crisp. You know, in a crisp manner, they are speaking a lot of things, meaningful things. So that is what you guys have to develop as well, because you can't act as an intern who's just reporting. You have to act as a manager also. You are replying to an engagement partner, so you have to be very you know crisp but yet meaningful. So communication, professional marks are given for communication. Professional marks are given for analysis. What do I mean by analysis? In a given situation, in a given situation, either you can think about 100% scenario, like you can cover the situation from 360-degree, or you can just think about one thing. So I don't know in your life how kind of a person you are. Like if a problem comes, do you think about that problem just from one perspective? You got to think about that problem from all the perspectives, 360-degree. So when I talk about that I've taken a loan, now that loan is going to impact my gearing. That's a business risk, because gearing is financial risk, right? So gearing means my company is risky company, so that's why financial risk, and that's why it's a business risk. And bank loan also suggests, what does it suggest? What about your interest cover? Will you be able to pay the interest, which is a contractual payment, once again, that you can link with going concern? Maybe the company is having some cash flow problems. So you have to think in all the directions in the given risk. You can't just think about one direction, that is the accounting treatment. All the direction. AAA is a combination of SBL and SBR. That's what I believe. SBL is also there up to some extent, like portion of it is less, but SBR is also there. So both these exams and one paper is made AAA with some spice of audit, some spice of ISAs. So that's what I have to do in analysis, evaluation. When you do evaluation, you again consider all the directions. You consider what are the cost of it, what are the benefits of it, what's the advantage, what's the disadvantage. You consider the facts, the figures. You talk about analytical procedures, you talk about ratios, you talk about trends. That is what analysis and evaluation is. Then we talk about commercial acumen. What is commercial acumen? Can anyone tell me what's commercial acumen? Do you know what's commercial acumen? Do we know what's commercial acumen? Commercial sense, knowledge of the business. Very right. So you cannot, you cannot be in your fantasy world, okay? You have to come out of it and you have to think like a businessman. You have to think like a commercially sound person who thinks about the cost and the benefit of the things, right? So you have to keep that commercial acumen also in your answers, just like you used to keep in SBL. When you were making some strategies, you were making some decisions. So you used to think on the basis of commercial acumen, right? So that is what you have to keep in your audit exam as well. So analysis, evaluation, commercial acumen, communication. This is what I believe is giving you majority of your professional marks, and of course your presentation. Right? So in question number 1 also there will be professional marks. So I told you what is question number 1 related to. So in question number 1, apart from planning stage of audit, you might even get some ethics. You might even get some evidences or procedures. What are procedures? Work done by the auditor. So first, as an auditor, when you get into any audit engagement, first you accept the client. There are some procedures which you apply before accepting the client. Do you want to work with that client or not? Is that client ethically right? If there's any ethical consideration to be given. What about the KYC of the client? What about the risks involved? Maybe it's a cash intensive business. I can say there's a risk of money laundering. So I have to consider various things about the client. Then I have to consider that what is the engagement terms, what should I put in my tender, and then the engagement letter would be signed where we will discuss and negotiate about the fees. So I need to consider, when I'll be auditor of this firm, will I be independent, or will this person, counter person, is going to exert pressure on me? So these are the things that you consider, right? And then you accept an audit client. Once you have accepted an audit client, now you're supposed to understand that client. You're supposed to plan the audit of that client. How can you plan the audit? You plan the audit with the help of AEIOU. What is AEIOU? A stands for analytical procedures. E stands for inquiry. I stands for inspection, observation, understanding. So you do AEIOU on your client and you understand this client's work and you plan accordingly. That means you assess the risks accordingly. What all risks my client might be facing? So there might be risk associated with their going concern position. Maybe they are having a bad current ratio. What's the good current ratio for any business? The good current ratio is 2:1. Yes. So that means if the current ratio is bad, I need to say that, you're doing bad. There's a risk, business risk. You might not continue with the business, or you might have going concern problem. That's a business risk. But with this business risk, I also have a risk of material misstatement. What is the ROMM here? What is the accounting treatment of going concern, uncertainty? First, I need to determine, am I still a going concern? If I am not a going concern, I'm supposed to prepare my financial statements at breakup value basis. And if there is uncertainty regarding going concern, uncertainty means that the probability is there that you might not be a going concern. It's not yet clear. So in that case, what do? You do disclosures in your financial statements. You provide extensive disclosures about this going concern problem. Now that is what I'm talking about here. That, can you see, I made a business risk. From this business risk automatically came up the ROMM or the audit risk. Then they say it's a new client. If any company is a new client, what do you think? If any company is a new client, isn't there a detection risk? You've just started the audit of this client. You've not known the client. You've yet to understand the client. You've never worked with their operations. You don't know about their internal controls. You don't know about what is their operations like in depth. You might be understanding them with their, some website or whatever discussions you have with your client, but you don't know it in depth. You've not worked with them. So once again, detection risk, right? So this is something that we have to make sure that we understand. Now, let us see what else comes into professional marks. In professional marks, guys, what I recommend is that you prioritize your risk. Prioritize your risks. And even the examiner write that please talk about significant risks. Please talk about only the risks which are significant or give them priority. So in this case, what you have to do is you have to understand that I have to first cater to the problem in the question. What is the problem in the question? If they are focusing a lot on a foreign subsidiary, so the foremost significant risk is about IS 21, foreign subsidiary, because they are focusing a lot on that. So when I say prioritize the risks, now here comes in the judgment. Now, ma'am, we are students. How will we apply judgments? We are not auditors. Okay, fine. That is what you develop with practice. I hope you all are doing past paper practices, kit practices. So while reading the answers of various audit risk, business risk questions, you must have seen what I thought was not there at the back of the kit. So maybe that was irrelevant. Maybe that was not that important. Because the examiner wants you to write something which is significant, something which should be dealt on priority, which is more important. So that also comes under professionalism. If I just babble around, if I talk about weather here today, if I talk about how was my day today, will it be relevant to the session? Will you call it professionalism? So when you're talking with an engagement partner, can you act unprofessional? Can you talk about stuff which is not relevant to the question in hand, case in hand, client in hand? Or can you talk about irrelevant things? Maybe that it's related to client only, but it's small thing, a very immaterial thing. So you have to be very relevant. He's asking you a question. Think you are a working student. Like if let's suppose you're working. So how do you communicate with your boss? If you speak about something irrelevant, They shut you out, right? So you have to be prioritizing the things and just reporting and writing about the significant risk. So let us try one question number one, and for that we will go to our paper, which is in first question of December 2023. I hope you guys can see my screen. And the ones who are not able to join the meeting, can you please ask them to watch it afterwards on YouTube if there's anyone on the group asking about this, because there's some problem with the Zoom meeting. It happened in SBR also, but yeah, we're not going live on YouTube, but they can watch this session afterwards. Okay. Now, let us get started. Okay. So the first thing over here in this question, let us see what's here. Partner's email is given to me. Requirement is given for 50 marks. Let us see the requirement. 40 marks requirement, 10 marks for analysis, evaluation, skepticism, judgment, commercial acumen. Skepticism is part of your syllabus only, that you have to keep a questioning mind. You can't simply say that if the client is saying this is truth, so you'll say yes, this is truth. You can't act dumb. You have to keep a questioning mind. So that's skepticism. Evaluation, I told you, when you think holistically, when you take numbers, trends, you perform analytical procedures, that is analysis and evaluation. Then professional judgment, like where we apply judgment, right? So you all know what is judgment, application of knowledge, training, and experience, where I talk about, according to my experience, this should be the materiality. So in the new type of materiality, we are given an overall materiality, we set a benchmark as per our judgment. So let us see what's given to us in the partner's email. That's basically our actual requirement. So let us see what's given to us in the partner's email. See, they're giving you briefing note is already given to you. To from this, you can simply copy paste this only, because you're supposed to prepare a briefing note here in the response option. So here they're saying, hello, I met with the group finance director yesterday along with representatives from the group audit committee. So we met the group finance director. So this is related to group audit. We discussed the group activities during the year and its plan to expand into further international markets. So what is their plan as a group? They want to go international. They want to expand in abroad. They also provided me with some extracts from the projected consolidated financial statements and a selection of key performance indicator. So we are given some financial statements which are draft, and we are given some KPIs, some ratios. I have also provided you with some background information about the group to assist the planning of the audit. So the engagement partner is addressing me and the audit manager. So I'm also a senior person. So you are doing a role play of a senior person. So please be responsible. And they're saying, based on analysis which I have done on this industry, it is appropriate for overall materiality to be based on revenue. Now, this is a new thing which they have introduced recently, which was not there in the past, where they're talking about a new type of materiality. So they're telling you, the engagement partner is telling you that this group, which he's considering, he is keeping the overall materiality on the basis of revenue. Previously, we used to have profit, revenue, asset. We used to decide if it was something related to liability, I would take total assets as a base. If it was something related to income, I would take revenue as a base, as a benchmark for materiality. But here they're giving for everything, our materiality is based on revenue. You will need to determine and apply an appropriate materiality threshold in your briefing notes. So you as an audit manager have to apply your own head, own expectation, subjectivity, judgment, that what do you think would be the materiality of this particular audit. Now I want to ask you, let's test your knowledge. What's the threshold when we keep our materiality on revenue? What's our normal threshold when we base our materiality on revenue? Yes. What's our threshold? Awesome. 0.5 to 1%. It's already very less. Now, this is just a benchmark. 0.5 to 1% is just a benchmark. Now, the engagement partner is asking that you keep the threshold according to your knowledge. So, this particular client which we have got, what is this client? Is this client new to us? No. This client is something which we've been auditing, right? So this is not a new client. We will read in the question. But while reading the question only, we will determine the materiality level. So you will decide for me and tell me what materiality you should keep. But before I start with that, what do you think? What do you think? If you have a new client, should your materiality be high or less? If you have a new client, less. Why less? Why low? If you have a new client, very good. If there is a new client, we need to keep our materiality at a lower level because reason very simple, there's a high detection risk, right? And what if he's an existing client? Then I can keep the materiality at a little higher level, right? So what I will do, I will not directly jump into the highest benchmark. I will move gradually, right? So usually you can take the midpoint. You can usually take the average. So this is something that you will have to do in your question as well, and they will not deduct your marks if you have taken, because already the what is your benchmark? It's 0.5 to 1%. Only 0.5 difference is there. So don't cry a lot about this. So you can apply your judgment in the exam if he is an existing client, but there are a lot of risky situations. Then also you will keep it on the lower end. If it is an existing client and the risks are less, then you can gradually increase the materiality level, because now we are accustomed to the controls and the procedures of this client, so we can keep it at the midpoint. We can increase it gradually. So let us see what's given to us. They're saying, using the information, I require you to prepare briefing notes for my use, in which, so let's copy and paste these requirements in our response option. Business risk. Okay, let's not copy paste because we have to prepare our briefing note. Or we can copy first and then later on we will delete this, okay? So that I might not open this partner's email again and again. So let us just copy it here. Later on, you will have to delete this because this can't be part of your briefing note, right? You have to be professional. You can't put partner's email only in your briefing note. Okay. So first of all, give a heading, briefing note. Let's give a heading. It's a briefing note. So this briefing note, you will just copy and paste from your partner's email. This is being addressed to whom? This is being addressed to Paula Sanders, Group Engagement Partner. So let's copy his name, and the subject and the date is going to be remaining same. So let's just copy this one and let's go to our response option and we'll say paste. So this is to this person, and what, from whom. So first you have from option. First you have to option, then you have from. So to. Then this is my subject, which will come at the next line. This is my date, which will once again come at a later line. So I will write from. From whom are we sending this? We are the audit manager. Yes, that's you. So this is your briefing note, which you have prepared as a format. So you will write an introduction paragraph in this. You have to showcase your communication skills. So put an introduction paragraph, underline this. This is my introduction paragraph. Here I will talk about the introduction of whatever I'm starting with. I'll talk about the client. I'll talk about whatever is my first requirement. So what's my first requirement? Evaluate the business risk. The first requirement says evaluate the business risk of this company, right? And let's read our group structure and activities for our evaluation. Let us close all the exhibits and let's just read our exhibit number 2, which is related to group structure and activities. So the group operates in a number of large hardware stores within the domestic market. Large hardware stores. The stores supply building materials and equipment to the public and to builders. The Hammer brand, which is internally generated and not recognized in the consolidated statement of financial position, is key to the group success. Do we recognize internally generated brand? Do you recognize internally generated brands? No, not in individual financial statement, but do you recognize them in consolidated financial statement? Do you recognize internally generated brand in consolidated financial statement? Yes, in consolidated financial statement, you do recognize them. See, we are very much dependent on this brand because they're saying it is key to group success. So if I talk in my answer, like if I just brainstorm over here, one risk which I can identify is that we are very much dependent on Hammer brand for our success. If you're dependent on a brand, that means you're dependent on the longevity of that brand. What about the fame of that brand? Right? So fame is something which comes and goes. So this is something which might impact you because you're dependent upon one factor. Your sales are dependent upon one factor, which is this brand. So we will say this is something which is a business risk. Imagine someday you become famous. So you'll always be like, what if I do, I lose my fame? What if I'm no more a brand? So you're worried about it. That means it's your business risk. You need to cater to that business risk, right? So that's a dependence on brand which we have. That's our number one business risk which we identified. And on the note, similar note, in my where they're asking me to prioritize and evaluate risk of material misstatement, they've written evaluate and prioritize. So do you think this is a priority ROMM? Is this a priority ROMM? This internally generated brand thing? What do you think? No, it's not a prioritized thing. We will refer to it if we will have less risks remaining. It's for 16 marks. So I can just write that I'm going to talk about internally generated Hammer brand, which is to be reported under IS 38. So I need a corroborating evidence. I need to see what is the materiality of this brand. Materiality is there because our success is dependent upon this brand. But the point is, are we having a significant risk associated with this? Is there anything that they've given further in the question about this? That is what I will determine. I will not hastily decide that yes, I'll put this in my answer. So I'll just brainstorm all the risks first, then I will prioritize them so that I can give a professional answer. So you don't, in SBR, you used to write in the direction of the case study, as in what you find, you type it. But in AAA, you need to first brainstorm and then make a final answer so that that answer is professional, where you've considered 100% of the things, right? So that is something which we will defer for now. Then one of the group subsidiaries, Wrench Company, is a financial services company specializing in providing saving accounts and loans to individual. Okay. So you are working in hardware and you are buying a subsidiary which is into financial services. So that is something, okay, fine. There might not be synergies. That is one thing which comes to my mind when I read this line. Then Mallet Company is a wholly owned subsidiary and operates Hammer stores. It generates the majority of the group income. So Mallet Company is a very significant subsidiary. It's a component, significant component of the group. So what is the term that you use for a material subsidiary? Significant component. Why? Because it is using majority, it is having majority of the group's income. So Mallet Company owns 50 retail stores across the country. Wow. And Mallet Company have been involved in a price war with another national hardware store during the year, offering significant discounts and heavily marketing the Hammer brand in an attempt to increase market share. Business risk alert. What can I write with regards to business risk here? Very good. First, I will talk about dependence on the brand. Second, I can talk about the competition here. There's a high competitive market. So this competition sometime in the future can affect my, you can say, presence in the market, right? This competition might affect my presence in the market. Secondly, what I can talk about is, what can I talk about next? I can talk about my cash flow. Why cash flow? Why will I talk about cash flow? Yes. Why cash flow? See what's given here. They are saying you are in price war, right? So price war means that first of all, there's a lot of competition. Secondly, what they're saying is that you are giving significant discounts and heavily marketing for the Hammer brand. So to increase your market share, if you not talk about cash flow, you can rather talk about liquidity in general. Because maybe to market yourself, maybe to advertise yourself, you have hampered your liquidity and you're just, increasing the market share. So you are draining the money like anything. Okay, so that might affect your liquidity. So first of all, competition means less revenue. We will see, we are given draft consolidated financial statement. So we will see whether the revenue has decreased. Let us see where's the financial information. So here is the financial information for Mallet Company. Also, they've given us. Okay, they have given us the group financial statement, not individually for Mallet. So if you see, my revenue has actually increased. Okay, so revenue has actually increased. That's good, but it has not increased very at a very high level. So that means my competition has somewhat affected me, but this might lead to liquidity problem because I am advertising a lot and draining a lot of my cash in the disguise of advertisement just to get market share. So that might create a liquidity problem for me. That's my identification of the point. Then what else? Ladder Company is an overseas subsidiary situated in far land. So this is an overseas subsidiary. That means we are having ROMM for sure is there. What would be the ROMM with regards to Ladder Company? So first of all, any ROMM you can talk about for Mallet Company. Mallet is a component, significant component first of all. The first subsidiary which we read, can you think about any ROMM with regards to that? No, foreign risk is fine. That is for the, yeah, you're right. That is for the overseas subsidiary. Ladder. We will have our group account risk. But what about this Mallet Company? This Mallet Company, the second subsidiary which we were reading, which was having a lot of cash flow drain, significant discounts and heavy marketing in an attempt to increase the market share. I don't know why. I don't know even if at the back of the kit they've given this or not. But do you think I will talk about biasedness here? Manipulation here? Because Mallet company is very eager to show profits, eager to get their market share. How do you get market share? Market share is also in ways of, getting your share price increased. So share price increases if you show optimistic results. So that's an inherent risk over here with Mallet company, which I can mention, of course. So I can say that, Mallet company, there's a risk of management bias, right? So that we've written identified. Moving to the next portion. The group obtained a 65% shareholding in October for a cash consideration of 82 million. The share purchase was financed partly by 32 million bank loan. What is the risk with the bank loan? Gearing is the risk. Let's put it in a business risk. We've taken a loan. Come on. That's a risk in itself. 32 million loan. We need to check what our total debt is. So this creates financial risk identified, right? So that is one thing. Gearing would increase because of this. So we will calculate gearing also if it is possible. With a variable interest rate, which was taken out in October 2014 and partly through group's existing cash reserves. The bank loan has convenience attached to it in relation to interest cover and gearing. So when there are convenience attached to it, so first risk, business risk is what if your debt convenience are breached. So come on, in your briefing notes, business risk, you can write here, debt convenience might be breached, which might lead to repayment, and repayment might lead to going concern problem. Then in my ROMM, I can talk about what is the risk, biasness, manipulation. Yes, because you've taken a loan, inherently risky, that you will make sure that your debt remains less. You might understate your debt so that you are maintaining your debt covenant and you're not breaching it and you're not leading towards uncertainty regarding going concern. So management might manipulate. So that's one thing we can talk about in the ROMM. Next, the purpose of the acquisition was to expand group's operation into a new geographical market. This is the first overseas investment made by Hammer Group, and Ladder owns 50 hardware stores in Farland. The 35% NCI in Ladder is owned by the government due to regulatory requirement that at least that proportion of the company share capital is government owned. What is this? Government is owning NCI. NCI is a headache to us. NCI is something which we all frown upon. That why is it here? Because you have to give your share of profits to NCI. But we are always happy that NCI cannot exert control because we are the parent. But if government becomes NCI, what would be your risk? What would be your risk? Political risk. Very good. Will the government let you control ladder company? Government will change its rules will change from time to time, and government can exert influence on you. You all know politically exposed persons, right? So government can control your decision by making its policies change. So you cannot say that I am a parent in front of government. So in that case, it becomes a little dicey that even if ladder company is something which you can consider as parent subsidiary relationship or not. So that is what I can write in my ROMM. So I can talk about acquisition of ladder. I've written already, but I'll talk about is there control in ladder. government, because government is involved. Then in the business risk, what can you write about this in the business risk? What can we write about this in the business risk? In the business risk, we can talk about latter is first foreign investment with that too with government, that too with government, and this might lead to failure, failure in investment. So there might be a failure of my investment. The investment might turn out to be bad. Then you can even talk about, yes, you can talk about compliance risk. But how can you talk about compliance risk? That, because it's a foreign subsidiary, there is a risk. Are you even complying with the international? Are you even sure about the international laws and regulations? You can talk about compliance risk. What do I mean by failure in investment? Failure in investment is this company is your foreign investment. They've said that you're making this for the first time. You're making this investment in a foreign country for the first time. And the risk is that you might fail. There might be some operational issues because the government is involved with you. So will you be able to operate properly and generate returns out of it? The risk is that your investment might turn out to be a failed investment. Something which is loss making to you. That's why. Okay, next. The currency is same as the current country in which the group is based. So can you write about IS 21 Forex rules here? The currency is same. So the people who will write about the foreign exchange rules, they will lose the mark. So if you have written it in your identification points, please move it from ROMM. Have I written it anywhere? Overseas subsidiary ladder, I can normally talk about group accounting risk. That means whether goodwill was correctly calculated, whether all the assets and liabilities, identifiable assets and liabilities were recorded in the working note number 2 or not. So when they have written that the currency is same of the subsidiary and the parent, then there's no point of talking about retranslation. No, there's no point of talking about average rate, closing rate. You lose marks. That means you've not read the case study properly. That is lack of professionalism. Then your firm was appointed as auditor for ladder company in October 2014, and several members of audit team have traveled to Farland to become familiar with the company, its key management personnel and its regulatory environment. That's a good thing. So Farland does not mandate the use of IFRS, and ladder companies' individual financial statements are prepared using Farland's national accounting standards. Come on. Which risk is this? What is the risk over here? Very good. The risk is that what about the alignment of policies? Which risk is this? ROMM it is. So you will talk about different reporting frameworks used. Different reporting frameworks are used, right? So policies will need to be aligned. There needs to be an alignment between the parent and the subsidiary. Who compromises if they're not consistent policies, if they're not following consistent framework? What is required? If parent is following IFRS, subsidiary is following some national accounting standards, what is required? What is the solution or way forward? You have done the merger and acquisition. Very good. Subsidiary compromises. Subsidiary must align. So subsidiary is supposed to prepare their accounts as per the IFRS, and then this proper group accounting would happen. So risk is, while doing this, the subsidiary might have done mistakes which were not identified. So all these risks we will talk about, right? So by now, how many risk I have identified for ROMM? 1, 2, 3, 4, 5, 6. This is the 16 marker. Do you think six risks are enough for a 16 marker? Do you think it's enough? How many marks do you get? You get MTR. First, you comment on the materiality. Then you talk about the treatment. Then you talk about the risk. Materiality, you always have to individually see whether this is material or not. So usually you get 3 marks per risk. So for 16, I've already identified 6 risks. But now there is more information available. That means I won't leave the question right now because I have to exercise my professionalism. So I need to find the significant risks. I cannot talk about all the risks. If I know that it's a 16 marker, I will just talk about 16 divided by 3. How much is that? Coming around approximately 4 to 5 risks. But those will be the most important 4 to 5 risks. So next says, Wrench Company is the financial services company of the group, operating from Hammer Bank. Okay. Its customers are mostly trade customers who obtain credit and loans. So it's just like a financial service, financial institution which gives loans, etc. for building projects. In the last year, the financial services regulator has been investigating many banks for charging excessive fees to customers in relation to loans, meaning that customers can claim back the excessive fees they have been charged. So what is this? If investigation is going against you and you might have to repay the money, what kind of situation is this? Come on, tell me. What kind of situation is this? Yes. Related to provisions. So what I'll talk about in my business risk. See, first of all, in my business risk, I'll talk about rent company altogether, a new company which is related to financial services, where my group, the whole group is related to hardware business. So that is something I might not be having enough information about this particular sector. And in my ROMM, I can talk about provisions, legal provisions required, provisions for legal claim. Yes, of French. So this is one of the major ROMM. We might not have created correct provision. So Wrench company received legal claims from more than 25,000 customers in respect of this, and the group recognizes 22 million in its financial position. So you will calculate the materiality of this, and then you will talk about the risk associated with this. So just by reading this exhibit, can you see how I have identified the risks and highlighted those points as well? So when I'll be framing my final answer, I will be very skeptical. I'll refer to this exhibit again. See, in AAA, there are professional marks. So please avoid copying things from the case study. In SBR, I used to tell you that please give a background and then talk about it. Here, the engagement partner. See, think about the real scenario. Who is giving you this information? Is God giving you this information? Engagement partner is giving you this information, right? So you cannot really, in your email, what information engagement partner gave you, you are also pushing the same information. Does that make sense? It is just like I ask you a question and then you give me the answer in terms of the question I asked you. That really happened with me. I gave a question of SBR as an assignment and the student gave back question paper to me to mark. So this means you are not supposed to talk about the question a lot. You have to be very professional and you have to frame your points way forward from the background. Right? That is part of your professionalism. Next, let us see what do we have. Financial information is also given to you. Let's quickly go through the financial information so that we can show the examiner that we are aware of the evaluation skill, because we need to evaluate together with our theoretical points which we are giving. So extracts from the projected consolidated financial statements, including notes for the year ending this 30 September 2015 and comparative information are included below. What is given to you? They're given you revenue, last year's actual revenue, this year's projected revenue. What's the percentage increase? Meanwhile, you can calculate that. What's the percentage increase in revenue? 11.9%. Okay, fine. Then they're saying in note 1, they've bold this, so that is an important note. Let us see. Exceptional items are those which are determined by management to be non-recurring. So first of all, guys, IAS 1 tells you that there are no exceptional items, but still they are taking operating profit before exceptional items. So this is their APM, additional performance measure, right? They're keeping this as their additional performance measure. They're saying our operating profit before exceptional item was this. So what is my exceptional item that they're considering? They are determined by management to be non-recurring. So risk is that this is subject to management bias. Maybe they want to overstate the figures. So they want to overstate the profit. That's why whatever they are including in exceptional item is incorrect. Maybe they want to avoid that thing. So what do they want to avoid? Exceptional items relate solely to store enhancement costs. More details are available on this in Exhibit 4. So the exceptional items in the prior period were audited in 2014 and no exceptions were noted. The executive directors earn an annual bonus which is based on annual increase in operating profit before exceptional items. Once again, this adds to the manipulation risk. Yes, this is increase in the risk of manipulation, management bias, because your bonus is based upon this figure. And the previous year's audit has said that there were no exceptions. So why are there exceptions this year, right? They have included the exceptions in the previous year also, but the auditor last year said there were no exceptional items. And this relates to store enhancement cost. So they are saying it's given in the next exhibit. Let's see what's given to us in the next exhibit regarding the store enhancement. So in February 2015, the group started a program of extending and renovating all 25 of Mallet Company's larger hardware stores. This is regarding Mallet Company. We started renovation and extension of it. Okay, fine. That's a good thing. Which will become destination stores and each will have a cafe or restaurant. The program is expected to cost 5.75 million per store. So you can calculate the materiality of this cost. There are 25 stores and you will incur 5.75 million for each store. At any one time, 5 stores are closed while the renovation and necessary construction work takes place. And on average, a store will be closed for 2 months while work is carried out. So the group considers this program to be extremely important to strengthening the brand and maintaining the market share. So the costs relating to these store enhancements included in the P&L are projected to be 65. So they've already given you a total, which will be separately disclosed as an exceptional item. What kind of risk is this? Is this ROMM or is this business risk? What kind of risk is this? ROMM or business risk? Both risks are here. ROMM is also there and business risk is also there. What is the business risk? See, they are saying that once you will be doing this renovation, you will have to close the store. So at any one time, 5 stores are closed while renovation and necessary construction work takes place, and on average, a store will be closed for 2 months while the work is carried out. So you can mention this in your business risk. Let's go to our business risk, what we've written with regards to Mallet company. I think Mallet company was the one which was having competition, right? Yeah. So you will add this point there. That first of all, you are having competition in Mallet company. So that's one thing that you'll talk about. And with extension to this point only, you will also talk about closure of stores while renovation. Also, they are saying that you're going to make, see, if you close your store, so the customer might go to competitor, right? That's a very major thing that we must talk about. The customer might go to the competitor. And then they're talking about, in this only, they're talking about some destination thing. So let's see what they're talking about. They're saying that the group considers this program to be extremely important for strengthening the brand and maintaining the market share. But the risk is that you want to be able to do this because of the store, because you are considering that they will become destination stores and each will have a cafe and a restaurant. What do you think is the risk associated with making this as a destination store? This is a strategy that you're putting. Yes, this is a strategy that you are making. See, what I can understand, if I was you, not sure if it would be successful, right? So they're saying it's a very highly competitive market. Mallet company is a very competitive company. So if this is a competitive company, we are talking about high discounts which we are giving to the customers. When you're giving high discounts to the customer, do you have enough funds available to cater to the customer? Like you give them a cafe and a restaurant in a hardware store. Does it even make sense if you're talking about that you are a low cost company? See, what you're giving high discounts because you want to maintain the market share. At one point, you're saying your revenue is slashing because you're giving high discounts and you have high competition. Then you're saying I'll be closing my stores so that I can do this renovation thing, and then I'll put a cafe, and they're trying to build it somewhat like IKEA, if you know this. So they want to create cafe and restaurant there, and that type of a hardware company we will make. But it's not a premium brand, no? It's a competitive market. You are not Apple. You're not IKEA. You are giving discounts. So you are not having that premium store. So you can't enjoy those things. So this risk, we will not give a proper conclusion, but we will say that there is a risk. Let's say risk of destination store destination store not successful, right? And then we've talked about the renovation part. And also, what else can you talk about in this case? They are saying how much cost are you incurring for this whole renovation? You're going to incur 65, and in addition to 65, there might be a cost of 55 million, which will be capitalized within PPE. There will be the expenditure related to car parking facility, constructing new facility, redecorating the stores. I am repeating it. Purchase and installation of shelving, labor costs, including some of the group own employee. What is the risk here? ROMM. Come on. Capitalization. You're going to have a capitalization. We will talk about capitalization of renovation costs. So the risk is that you've not done this correctly and there is a misstatement because you need to bifurcate between what is revenue expenditure and what is capital expenditure. So anything which enhances the productive capacity of the asset is capital expenditure, and anything which is general, which is related to repair and maintenance, that is revenue expenditure. So you need to completely see whether the classification between this is correct or not, revenue and capital. Right? So this is one major point which we've identified. Then the group considers this program to be extremely important to strengthening the brand. Okay, fine. Sales promotion. In response to the actions of a major competitor, the group introduced several sales promotions during the year. So just looking at the competition only, this point relates to the competition point of my business risk. So just because of the competition, what I'm doing, I've introduced sale promotion, and the promotion includes heavily discounted product lines, buy one get one offers, mainly applied to groups, paint and wallpaper lines. Awesome. So that just corroborates my point of low cash flow, liquidity problem, because revenue would be less, working capital would be less, but your loans are more. Even for this particular 65 million, you might have to take any additional loan. So that is also something which can hamper your liquidity. So these are the points which we have identified. So this exceptional item thing, we will write about this again in our briefing notes. So in our ROMM, this is something which we'll talk about, and we'll talk about exceptional point. So let's just write one more point, exceptional item. This is a very major risk. Reason that they have given such huge information, a proper exhibit is on this point. So this is something which is very important. So you need to place it ahead, like in the top list, priority list. They have properly given an exhibit on mallet companies competition, its renovation, and this exceptional item. So this becomes a very major risk. That's how you apply your skepticism, and that's how you apply your professionalism, that my engagement partner has literally given a proper exhibit on this particular case. So I need to prioritize this. Right? So that's one thing. Let's move on. Inventories include materials such as painting and decorating materials, timber and doors, as well as tools and equipments used by professional builders and customers. Which inventory are they talking about? They're talking about the total assets inventory. And the inventories are measured in accordance with IS2. The group operates a stock take once a year on 30 September in their stores. So they've given me some point related to inventory. What can I write with regards to this? Inventory point. What can you write? Any risk which you can find from here related to inventory? Valuation. Risk is about the valuation. Whether you have measured it at lower of cost and NRV or not, that's one thing. Then they are saying, we're talking about mallet companies inventory, right? We're talking about painting and decorating materials, timber and doors, tools and equipments, do it yourself or DIY customers. And if you read this business development point, they are saying that the group has introduced several sales promotion. You are doing heavy discounting. When you do discounts, the inventory valuation becomes further risky, right? Because of the sales promotion, the inventory valuation becomes riskier. Why? Because NRV reduces, right? So the risk is that you've not taken this into account. Because inventory is valued at lower of cost and NRV. If you are reducing your fair value, if you are reducing your selling price, you need to make sure that you are accounting for it in the valuation of inventory as well. So you will determine its materiality and treatment and then the risk. Then they've given you some ratios. Gearing is given. See, gearing has increased. Oh my God. Gearing has increased from 35 to 68%. Come on, use this point in that bank loan point and that debt convenient point. Then current ratio 1.4 and then 1.1. Both are low. because the adequate ratio is 2:1. So they both are low. 1.4 and 1.1 both are low. So I will refer this in my question, in my answer, that 1.1 has further decreased. 1.4 is already low, and by taking it to 1.1, it has further decreased, and that's of no use to me. That's a bad thing, right? Yes, do we understand this? Interest cover has also decreased, so that's also a bad thing. Are you ready to make your answer now? This additional service is related to ethics point. So I can leave this portion because they've written additional services. So this is related to my requirement of ethics. Shall we frame our answer now? Are we ready? Is everyone ready? Okay. Let's go on with our business risks first. 10 marks business risk. I at least need 5 points for that. So what is the introduction that we can give in this particular question with regards to the... Yes, can you give me an idea of introduction? I want all of yours answer. Can you give me an idea of introduction that I can give to the engagement partner? What you will write? You will talk about the requirement, summary of the requirement. Very good. So what we will talk about? These briefing notes. This is something that you need to mug up. You will use it in the beginning of each and every briefing note. So these briefing notes have been prepared for your use in planning the audit of the hammer group for the year ended 30 September 2015. Then you can talk about this client. The group is an existing audit client, right? Is an existing audit client, and these notes will evaluate, or these notes evaluate. They asked you in the requirement that you need to evaluate business risk, you need to evaluate and prioritize risk of material misstatement. These notes evaluate significant business risks faced by the client and prioritized risk of material misstatements based on the information provided above. The briefing note further evaluates. What's my next requirement? My next requirement is about audit procedures in regards to expenditure and ethical issues. Further evaluates the suggested audit procedures to be conducted with regards to the store enhancement, and also suggests some ethical issues some ethical issues and safeguards regarding some ethical issues and safeguards affecting our firm due to this claim. So this is a kind of introduction that you have to give. So you have to say that these briefing notes, it will consist of this and this, and you have to mention whether it's a new client, existing client, it's an individual client, or it's a group audit. You can mention that. That is a kind of introduction that you have to give. Now the first thing that you have as your A part is business risk. So evaluation of business risk. First risk that we identified, dependence on Hammer brand. So first risk is dependence on Hammer brand. From which line did we determine this? They said that Hammer brand, which is internally generated and is key to group success. So we will say the Hammer brand, which is internally generated, is key to group's success and any damage to the brand would have a counter effect on the group's competitive advantage, as already the group is working in a highly competitive market. Yes. Further, what you can talk about the Hammer brand. Is there anything in this question which is impacting our brand? Can you find anything which is impacting your brand here? Do you remember this bad thing of wrench company? Do you remember this? The legal issue, right? So you can mention that over here. We can say any impact on the longevity of the brand will impact group's revenue and thus overall profitability. The legal claims going against wrench company, which is a subsidiary, might bring disrepute to the Hammer brand as a whole, as a material amount of 25,000 customers have legally claimed against wrench. Right? What else can we write? Let's talk about too much marketing that they're doing. Do you like anyone who's doing too much marketing? Normal marketing is fine, but if we see anyone doing a lots of marketing, at the end of the day, we do get a little offended, right? So that is something which we can talk about as well. So what we can say is also the sales promotions done by the group in the given situation, to increase market share can also impact the reputation, or can also impact the customer's mindset, and can lead to loss of customers if the marketing is too aggressive. Yes. So too aggressive marketing is also not what we are, happy about. So that becomes irritating. I hope I do not irritate you guys. Okay, so that is something that is irritating. Right? Next, what can we write? What is our next business risk? Competition. So let's talk about competition now. What will you write with regards with competition? Come on, what will you write with regards to competition point? You'll talk about the environment where we work. So we will say, we will refer to the exhibit once again. Where did we read this line? We are in price war, right? So there is a price war and we are giving heavy discounts. We are heavily marketing to increase our market share. And with regards to this, we even read something in the business development point where we were talking about heavy discounts, buy one, get one free offers are being given. So we can relate this and make an answer here. The hardware industry, in which group operates, is a highly competitive field, as there is a price war between the mallet company and its competitor, and together competitor, the safeguard in this competitive environment taken by the group is in form of sales promotion, high, or you can say heavy advertisements. But all of this might lead to drain of cash flow, and this might lead to drain of cash flow and lower revenue. Rather, you can just replace this. This might lead to lower revenue, and because you have reduced the prices, lower revenue, and in form of sales promotion, discounts, which might lead to lower revenue and drain of cash flow. Then the risk is that these strategies of price penetration, this is price penetration, right? So these strategies of price penetration might not be successful, and the customers might choose for alternative stores. Then you can even talk about this point of cash flow. So also the liquidity might also might be affected badly, as even suggested, as even depicted in the decrease in current ratio from 1.4 to 1.1, and decrease in current ratio, right? So that means our liquidity problem is happening in this case, right? Then what next? We wrote something about the competitors more. What was the competitor? Closure of stores while renovation. Customer might go to the competitor. Risk of destination store not successful. So what you can do is you can make another point out of it. You can make a point of renovation and store extension. So here you're going to talk about what? You're going to talk about the store extension in the business development part that we had. So how much cost are we incurring? We are incurring a large cost of 5.75 million per store. So we will say the planned the planned amount to be spent on renovation of 25 stores is really huge and material, and the risk is, if renovating and expanding the stores into destination stores would be a successful strategy or not. Would be a successful strategy or not. In this competitive industry where price penetration strategies are used, introduction of cafe and restaurant in the store might act as a premium facility, which will just increase the cost. Meanwhile, the revenue and selling prices remaining constant. So that would just increase the cost, right? Then what else can we write? So this is something which might not give us a good return. Then what do we have written with regards to it? Closure, yeah, that's one point. Also, to renovate a store, it will remain closed for approximately 2 months. And within that time span, the group might lose the returning customers, the returning and loyal customers of the brand, to the competitor. So one day you go and you have a favorite grocery store near you, and one day it is closed. I'm sure you'll explore another store because you have to buy the milk. And if you like that shop, now you will start buying from that shop. So that's how people lose their loyal customer if they don't open up on time and if they're not available. So this is how the competitors will get the advantage, because if you're doing renovation, your store will be closed. If your store will be closed, the customer will go somewhere else. right? That's also a business risk. Then further, what we can talk about is, what else do we have? Liquidity. So let's talk about the liquidity problem as a whole. Liquidity is a problem. What is the problem with regards to liquidity? There was a bank loan, no? What's the bank loan? Let's see, 32 million bank loan was there. So we can refer to it. For acquisition of ladder company, we've taken a bank loan of 32 million, and the debt covenant is interest cover and gearing, which is decreasing. So that is going to lead to a risk. So we will write, to finance the acquisition of ladder company, the group has entered or has taken a bank loan of $32 million, $32 million, which has debt covenants attached to it regarding gearing and interest cover. Yes. So what will I write with regards to this? I will say, you can talk about the materiality of this loan. So how much percentage is this loan? 32 million of total assets. Are we given the total assets? Let's check our financial information. The total assets are given to us as what? 500. So 32 million. How much percentage is 32 million of total assets? 6.4. Very right. The loan is highly material. The loan is material as it is 6.4% of total assets. Yes, this is 6.4% of total assets. So what I will write with regards to it, this new loan will add to the debt base and thus increase the gearing further. The gearing is already at a danger level of 68% and has seen a huge jump of, what is the percentage of jump? Come on, calculate. From 35% it has increased to 68%. What is the percentage of jump? 33. Yes, a huge jump of 33%. Yes. Then what else will we say? Also the gearing with the increase in gearing and decrease in interest cover, the debt covenants might be breached, leading to uncertainties regarding going concern. Yes, so that's something which we can write as the business risk. Then what we can talk about is, we've talked about liquidity, we've talked about the loan part together with it. Then ladder is our first foreign investment with the government, and also about the international risk. So these are the three risks which remain. So let's talk about investment. investment in ladder. Ladder is an overseas entity, and the group has invested a material amount in it. How much have we paid? Let's see. To acquire ladder, we've paid 82 million plus 32. So, okay, 82 million in total. Cash consideration is 82 million. So we've made a material investment of 82 million. So if 32 million was materials, of course 82 is also material. So it's an overseas entity where group has invested a material amount of 82 million in it. Then next what we will write? The risk is that this investment might turn out to be a failure, because it is made in far land whose rules and regulations the group is not aware about. And that gives rise to compliance risk. Also, the what can we talk about in this from acquisition of ladders point of view? We will also say, also there might be some operational issues with regards to the government of Farland acting as NCI in the group's investment. The government can dilute the power of group in ladder with its changing policies. Government can change its policies and it can dilute the power of the group. Right? This might lead to operational this thing. So such a political pressure / interference might lead to loss making on foreign subsidiary. Yes, so you might not get enough returns in your foreign subsidiary because you might generate losses because of the interference of the government, right? Then what next is given? Yes. So also it's a first foreign investment. So you can mention that point here, that overseas company and has invested material amount of 82 million for the first time, right? That's it. Then what else do we have? We have international compliance risk, laws and regulations that we've mentioned. Then rent company financial services. So let's talk about that. Do we need to write more? 1, 2, 3, 4, 5. 5 we've already written. And I remember writing about the rent company over here. So I've already written it about in the first point only, that rent company might affect our brand value because that's a bad thing which has happened with us. So I think for 10 marks, these 5 points are more than enough because in each point you've written qualitative things. So if I have to mark this answer, let me show you the marking. How would I do? If you believe that, these are so many points, I want to be able to write these many points in my exam. if you have that feeling. Let me tell you this, the whole thing that I've written, this is giving me more than 10 marks. So if I have to mark this, see, how will I start the reading of the answer? From here, okay? So first of all, internally generated is coming from the question, so no marks for this. It is key to group success coming from the question. Any damage could have a counter effect on the competitive advantage, as already the group is working in highly competitive market. So that gives me 1 mark. Then any impact on longevity of the brand will impact the revenue and thus overall profitability. The legal claims, this legal claim point gives me 1 mark. So 2 marks over here. Then I've written that sales promotion, this will give me another 1 mark. So 3 marks here. Then the hardware industry in which the group operates is a highly competitive field. That's again a repetition thing. And as there is a price war between Mallet Company and its competitor, the safeguard in this environment is sales promotion, but all this might lead to lower revenue and drain of cash flow, 1/2 mark for that. The risk is that these strategies of price penetration might not be successful. That's another 1/2 mark, and customer might choose to go to alternative stores. Also, the liquidity might be badly affected as even depicted in the ratio. So that gives me another 1 mark. So total 2 marks for this. Then renovation and store extension. The planned amount to be spent on the renovation of 25 stores is really huge. So that is something which is okay, we can mention it. Successful strategy or not, that's 1/2 mark. Competitive industry. One thing that I can see bad in my answer myself is that I'm writing again and again that this is competitive industry. So that is something which we can avoid and just mention in the introduction. Then where price penetration strategies are used in production of cafe and restaurant, this might lead to decrease in our profits. So this is giving me another 2 marks over here total. And also the renovation of a store, it still remains, so that is giving me another 1 mark. So in total, I'm getting 3 marks over here. So how many marks till now? 1, 2, 3, 4, 5, 6, 7, 8. Out of 10, 8 marks still here. I'm deleting this. Come to the next. What do you have? Liquidity and investment part. To finance the acquisition of ladder, the group has taken a bank loan of 32 million, and the loan is material as it is 6.4% of the total assets. That's a 1 marker which I'm getting. The new loan. Now you might be wondering that here the materiality was based upon revenue, but this is business risk. Usually you calculate materiality, risk of material misstatement. This is business risk. So here you can take whichever materiality you want to take, and usually since it's a loan, we take the asset as our materiality. Then this new loan will add up to the debt base and increase the gearing further. The gearing is already at a danger level, so that is giving me another 1 mark. Also, when the gearing increases, the debt covenants might get breached, which will have a going concern problem. That gives us another 1 mark. So 3 marks here. Then ladder, so already 11 marks in my hands. Then ladder is an overseas, no marks for this line. The risk is that this investment might turn out to be failure because it is made in foreign land whose rules and regulations you do not know, which gives rise to compliance risk, 1 mark for this. Then also there might be operational issues with regards to government of foreign land because of their changing policy and political pressure and interference, 1 mark for that. So 2 marks over here. So are you understanding the marking scheme of business risk? It's more like 1 mark, 1 point, but that point needs to be like if you elaborate that point and write further about it, then it will be counted as 1 point only. Like here I talked about operational issues and then I explained it till here. So that's 1 mark only. Are we all clear till here? Can I move on to the risk of material misstatement part? All awake, enjoying the session? Are we here? Yes. Okay. Let's move on. Have a cup of tea or water, whatever suits you. Okay. Next. Let's talk about our B part now. What's my B part? The B part relates to risk of material misstatement. So here what you will do, I'll show you how you talk about materiality. First, you will put your materiality paragraph here. So in this materiality, now here you talk about that materiality which is given in the question. Right? So what is there in my materiality paragraph? I will talk about that. I'll copy that line from the partner's email where he said, we discuss in the group activities to expand the, okay. I've also provided you, where is he written this? Based on analysis which I've done, this overall materiality is to be based on revenue. So let us put this out here. So what we will say, we are making our briefing notes. So for the purpose of these briefing notes, overall materiality is based on revenue. Is based on revenue. So what will be the revenue? The benchmark for materiality, the benchmark is 0.5% to 1%. And since this group is an existing client, but do you think we should keep the materiality higher or lower? Now you've read the whole thing, you've read and identified the points, the risks. What do you think? Where should I keep the materiality? Is the risk high in this company or not? The risks that you assessed, audit risks that you assessed, are they high? Very high. There are so many audit risks that we've assessed with regards to that store expansion and that particular, new expansions that we are doing. So what should we do? We should keep it at a lower level. So since this group is an existing client, but with high risks of material misstatements, the materiality should be kept lower, at a lower level. So what should be my materiality? If I just take this benchmark in total, so what's the benchmark here? If you calculate the range, what's your revenue? Come on. My revenue in the financial information, I don't know why this zoom out. What's my revenue? 450 is my revenue. What is 0.5% of 450? And 1% of 450? Very good. 2.25 and 4.5. So just write it there that material misstatement, the materiality should be kept at a lower level. The benchmark is coming out to be 2.25 million to 4.5 million. Yes. And since this group is an existing client but with high material misstatement, it should be kept at a lower level. So I will keep it at lower level, which is what? What level will you keep it at? 2.25? You can see 2.25 is once again a decimal place. So you can keep it at a whole amount, like take it to one decimal place. Not whole amount, but take it to one decimal place. 3.3, no. 2.3. You can keep it as 2.3. Lower level of 0.5%. Therefore, the materiality is kept at 2.3%. Done. Now let's start with our first points. See, first I gave you, they have two you have to give priority risks first, because in the requirement they've clearly mentioned that evaluate and prioritized. So out of all these points, internally generated brand, I didn't have a lot of points related to it in the question, so I can totally skip writing this. Then with regards to this exceptional item and these capitalization of renovation cost, yes, this is something which has been quite, you can say, important things, because we have a proper exhibit on this only. This whole paragraph relates to expansion. And then if you read this point which you read, what is that you can do? They've given you some information, they've given you revenue, they've given you profits, they've given you finance costs. What can you do with this? Can you see the analysis? Your operating profit before exceptional item has moved from 78 to 97. You guys calculated your increase in revenue was? What was the increase in revenue? 11 point something, I think that's what you calculated. What was the increase? 11.9, right. And what's the increase in operating profit before exceptional items? How much? What's the increase from 78 to 97? What's the percentage increase? 24.3%. Okay. So when you say that, understand this thing. They are saying operating profit before exceptional items. So let's make a point of this in our briefing notes. We will say, first let's give a heading, exceptional items. So this is something which we need to talk about first. And then in the exceptional items, we are talking about analysis that we are doing, analytical procedures, which we will conduct. That's our first things, prioritize things that suggests our evaluation skill. And then we will refer to the renovation or the, you can talk about renovation costs, capitalization of renovation cost. That's the second most important as per my judgment. And then what I have is significant component is there. That means Mallet Company's acquisition. That is of course there. But I think the latter company was something about which they've given a lot of information. If you see. So ladder, second is this big paragraph about ladder company. So I think ladder company, that would be another important thing, acquisition of ladder company. Then what is the third paragraph, which is most lengthiest one? So this we've already taken, store enhancement. Next lengthiest one, I think wrench company is the next lengthiest one. So we can talk about that. Yes. So wrench company. And then we can talk about that inventory valuation as well. And that's like what all we have identified, right? All these points we can take here and there, like manipulation loan, is there any control in ladder, different reporting frameworks used? That's part of ladder only. Yeah, that's it. So let's talk about these. First, the analytical procedures. We will first mention about the analytical procedures, where we will say that the operating the operating profit margin before exceptional items have increased by 24%, which is quite inconsistent with the fact which is quite inconsistent with the fact that in the current year, group has given heavy discounts to attain the market share and get competitive advantage. So when you give discounts, don't you guys have less profits? And they are saying that your profit have increased by 24%. That's quite fishy, no? Because you're saying you're giving discounts and you're facing competition. So how can your profit increase to that much level? You can even corroborate this with the fact that if you compare this operating profit after exceptional item, it is reducing. Can you see this? From 30, it's going to 32. Can you tell me the decrease in this percentage? Decrease in the percentage from 30 to 32. 6.7% decrease. So we can mention that over here. So the operating profit before exceptional items have increased by 24%, and however, the operating profit after exceptional items have decreased by 6.7%, right? So here we can say there is an incentive to the management. There is an incentive to the management to overstate the profits before exceptional items, because the director's bonus is based upon the director's bonus is based upon the performance upon this figure. Thus, the risk is that there is misclassification of expenses as exceptional items with a motive of overstating the operating profit to enhance or to maximize the director's bonus. That's one thing. Then what you can say, what else can you say with regards to this? We can also say the determination of exceptional items is subject to management bias, is subject to professional judgment, and thus subject to management bias. Also, IS1 states that IS1 frowns upon recognition of exceptional item. So IS1 says there is no exceptional item at all. So it frowns upon the exceptional item. Right? Then what can we talk about? What is the exceptional item in our question? What's our exceptional item? They've said that the store enhancement costs are considered as non-recurring and therefore are part of exceptional items. So can you consider it as exceptional item? What will you say? There's a risk. So you will say the renovation slash store enhancement costs, or you can say the risk is that the renovation slash store enhancement costs are incorrectly classified as exceptional items instead of normal operating expenses to maximize the profits and thus bonuses. So this is something which is a risk. Then the capitalization of renovation cost. Come on, come to that point of renovation cost. What's our renovation cost given to us? How much is the renovation cost? It was over here business development. So total renovation cost was of 65 plus 55. What is 65? Total cost was not 65 plus 55, sorry. It was 5.75 into 25. How much is that? 144 approximately. So you can write it here. The total store enhancement costs of 144 million. Is it material? First, you need to determine the materiality. Your materiality level is 2.3 million. So 2.3 million. Is it material? 144. Yes, highly material. So the total store enhancements cost of 144 million is highly material. Yes. Then you'll talk about its treatment. What is the treatment? Under IS 16. Under IS 16. Will you apply IS 16? Yes. Or will you apply IS 38? What do you apply? IS 16. So under IS 16, only the costs which increase the productive capacity of an asset is capitalized, and the general repair and maintenance costs are expensed. There is also, what do you do? Also, once capitalized, the asset must be depreciated if once the asset is ready for use. So you will say the risk is that the revenue and capital expenditure is misclassified, and the assets and profits are overstated. Why did I write overstated? Because your general intention over here is because you're getting some bonuses that you want to increase your profit. So if you capitalize your expenses, then you will be able to save your profits because expenses slash the profits. So that is something which we will write in general about capitalization point. Then acquisition of ladder, what will you talk about this? How much are you paying for acquisition of ladder? Yes. This is the ladder company. First of all, you're paying 82 million. Is this material? Yes, this is very material. Then we will talk about this, whether even we have control over this or not. And then we'll talk about this point of different standards which are being used by ladder. So first, let's talk about the risk number one. There is a risk regarding identification, correct, incorrect identification of ladder as a subsidiary because subsidiary due to the presence of government as NCI, there might be dilution in the power of the group. So skepticism, professional skepticism must be applied to conclude if the subsidiary, if ladder should even be considered as a subsidiary. So that's one point we can write about it. Then second, we can mention assuming ladder is a subsidiary, the risk is that IFRS 3 was incorrectly applied. IFRS 3 states that upon acquisition, the identifiable net assets of the subsidiary are recorded at fair value. The determination of fair value in itself is a subjective, thus inherently risky area. Thus, the risk is that the goodwill on acquisition is misstated and not all of the identifiable assets and liabilities of the subsidiary are recorded on acquisition. You can even mention that there are some danger items like internally generated brands, and that um, internally generated brands which are there, contingent liabilities which are there, right? Okay. Then, Next, what else can you write? You can talk about the standards. The risk is, or you can say, the ladder company follow national financial reporting framework, whereas the group follows IFRS. This inconsistent, this will lead to inconsistent accounting policies across the group and inconsistent reporting frameworks. The risk is that subsidiary might not be expert in IFRS application, and there is an inherent risk of material misstatements in the financial statements which might be prepared by the subsidiary using IFRS, because they don't know about IFRS. So see, this is the easiest part. If you guys were good in your SBR, I really enjoy these ROMM. That's the reason I teach audit. Because these are very, very easy things if you understand the standards. Otherwise, if you're not good in the standards, then this becomes a painful point for you. Otherwise, it's that oasis in the desert. Then wrench company. What will you write about the wrench company? How many points, how many marks am I getting till now? So I'm getting 1 mark for this. 1, 3, 4, 5, 6, 7, 8, 9, 10. 10 marks I'm already getting. I need just 6 more marks. Wrench company. You can calculate the materiality of the provision. So it was 22 million. How much is 22 million? Is it greater than 2.3? So materiality of provision, highly material. Yes. Now let's talk about its accounting treatment. What is the accounting treatment? IS 37 states that IS 37 states that if there is a present obligation, if there's a present obligation for future cash outflow or future outflow of economic benefits which arises due to a past event and is probable, must be provided for. The risk is that the provision of 22 million is understated. Also, the probability of the legal claims or the probability of wrench company ending up paying the legal claims is a subjective or is a is an area, is a judgmental area which is subject to management bias. Management bias, right? And then what else can you write? What else can you write? This is inherently risky. There's a present obligation for future outflows which arises, so the risk is that provision is understated. Also, the probability of French company ending up paying a legal claim is generally subject to management bias. So I think this is enough. Further, you can explain as much as you want. Then inventory valuation also similarly, you can talk about the inventory valuation which is being done. Your inventory is given to you as 75. So is that material? Yes, even that is material. So 75 million inventory is material. Yes. Then what will you write? You'll talk about its valuation. So IS2 states that inventory is recorded at lower of cost and NRV. What is NRV? NRV is equal to fair value less cost to sell. With the sales promotion, the group is with the sales promotion happening, with the sales promotions which are happening, the selling price would be affected. Therefore, this will further impact the net realizable value, which will probably become lower than the cost. The risk is that the group management does not review the NRV correctly and might have overstated the inventory. That's it. So this is what we will write for our risk of material misstatements, and then you can at the end give a conclusion, like a small concluding paragraph. What can you write in conclusions? If you were writing this to your manager, your engagement partner, what can you write as conclusion? Yes. What can be written as conclusion? It's a very risky business. You can talk about the gearing of this, and you can talk about the business risk this company has, the numerous risk of material misstatement which has happened, and the fact that you've prioritized your ROMM. There are many other ROMMs as well, but you've just prioritized few of them, right? Then classification of that latter company's big problem, and then you can further discuss about the management bias which is there, that expenses and those stores. You can just give a brief about those significant ROMs, right? So we need proper evidences and procedures to be conducted. Very good. So this is what all we will write in our first part of the question, which was for 26 marks. Do we all understand this? Yes. Okay. Now guys, they are asking you in the third requirement, they are saying, using Exhibit 4, design principal audit procedures to perform in respect of expenditure relating to the store enhancement program. So come on, let me show you how do you write your audit procedures. Audit procedures on store enhancement costs. So how do you frame good audit procedures? Good audit procedure means that I'm going to write about a verb. It's for 7 marks, so I need 7 audit procedures, right? So I will talk about a verb that do this, auditor should do this. Why should he do this? What assertion he is checking? And if I say recalculate, recalculate what? And then why to recalculate? That's how I make a perfect audit procedure. So let us frame some audit procedures. Can you give me an idea? Group enhancement, store enhancement cost was related to IS 16 revenue and capital expenditure. So can you give me a few ideas relating to that? What can I write? Yes. What can we write with regards to that? Inspect the schedule of expenses. Why? Vaishnavi, why? To check what? Okay. See, check this. They are saying that we've started a program of extending and renovating all 25 company hardware stores. So, which will become destination stores and each will have a cafe and a restaurant. So, the program is expected to cost this much per store. So, they are giving us an expectation, right? And relating to this, we have already included a projected to total 65 million by the financial year end, which will be separately disclosed as an exceptional item. And 55 million in addition to 65, 55 million will be capitalized. So what we need to do is first we need to check our projections. Yes. So discuss with the management. What can you discuss with the management? Discuss with the management to understand their assumptions behind the projection of $5.75 million cost per store to to verify the accuracy of the projected cost. Then second point, what can you write? Physically verify the stores to why would you physically verify the stores? To confirm the existence of renovation of the stores at the year end. What else can I write? Very good. Obtain board minutes. So obtain board minutes to ensure the approval of store extension, store enhancement. Then what else? Okay, obtain the value of each expenditure from the expected schedule to verify. Okay, what else can we say? Since you are making projections, so we can say compare the previous projections, compare at the year end the projected cost and the actual cost incurred on renovation and inspect any variances to enhance or to verify the accuracy. So there is a projection of cost being made. So I can just look at my budget and I can look at the actual thing which has happened and I can inspect the variances, and this will let me know if they whatever they are doing, is it even true or not. Okay. Then we can obtain a schedule of total cost. So what will you do? Obtain a schedule / breakdown of total costs, total costs incurred till date to evaluate the nature of expenditure and to ensure completeness and accuracy. So have you included everything, and to check what would be the nature of it, and is it included at the correct amount or not? What else? If you see the question once again, they said that there is extended car facility, labor cost, including some of the group's own employees, right? Then what you can say with regards to it? Discuss with the management their reasons of considering 55 million as capital expenditure and 65 million as revenue expenditure to check the reasonableness of their assumptions, to further ensure correct classification of expenses. What next? You can obtain bank statement. Of course, you can write about bank statement. Supplier invoices can be obtained, even the labor costs. Very good. Obtain HR records to confirm the labor cost paid to the employees. So to the labor, you don't pay, the HR doesn't pay the money. It's not the HR. You have some time sheets, you have some payroll sheets, you have some wages per hour. So what you can say for the labor costs? Agree a sample of costs like wages per hour to payroll records, timesheets, and bank statements to ensure accuracy. So this is what we can write with regards to our store enhancement, or with regards to our this renovation thing. Do you guys understand this? Do we all understand? There's a land being purchased. Yes, so you can talk about its ownership document. Have you purchased the land? Have you correctly classified that land or not? So there are a lot of points which you can make a further additional point out of. Right? That's it. So the next part of it is related to ethics. I'm not going to discuss that. You can read this additional services point that basically relates to investment advice and consolidation adjustment. So these are the non-audit services uh, which we are providing to our audit client. So we need to mention that, whether it's even allowed under the ethics or not. That is what they're asking you here. So that is something I hope you all have been doing since F8. You've also done this in SBR. So I can entrust you with that. But these were the points which I wanted to discuss with you. See, here you will end your like the whole thing you're giving as a briefing note, right? So this question, the major portion was the risk portion, 26 marks. 7 marks here were like bonus, cookie points. If you guys, get the skill of writing the procedure, 7 marks, like you won't even lose 1 mark in that. Procedures is highly scoring area. They don't deduct your marks. The examiner is going to deduct your marks in a professional question, like risk question, where you have to write, you have to use terminology. In this procedure, if your keywords are on point, each procedure which is correct, which has a verb in it. What is the verb? Discuss is the verb. What is the another thing? What am I discussing? I'm discussing their assumptions. Why? Because I want to verify the accuracy of the cost. I'm discussing the projection of 5.75. I'm obtaining a schedule of what? Of total cost. Why? Because I need to see the nature of expenditure. I am discussing with the management. I'm comparing. What am I comparing? Projected cost to actual cost. Why? Because I want to verify the accuracy. So this is something which is a wholesome procedure, and each procedure will give you 1 mark, and this is something you all should get. When I gave my AAA, I made sure that I have that skill of writing procedures and evidences, and that was the only reason I was able to pass this paper. Because I remember I gave this exam in a very bad health condition, and it was like I was totally not in a good frame of physical health when I was typing this paper, writing this paper. Back in my time, it was on paper. So only the procedures helped me pass. Because even if I was sleeping and I was given a question on procedures, I would have written those procedures. So I was in the worst state and I was able to write it. And that only happened with the practice and the technique of writing a procedure. And that's what I want to pass on to you as well, that audit risk, you all will manage. Business risk also, you all will manage. Procedures, please pay attention to it. Ethics also, you all can manage. So these are very, you can say, questions which require skill, time, they lead to exhaustion of your mind. But at the end of the day, they'll give you a lot of marks provided that you write it in the correct technique. So if I write general procedures, if I babble around, I won't get the marks. That's why audit syllabus is easy, but the audit's typing is different. So with regards to what I was writing on your Word file, we've done what is there in question number 1. In question number 2, usually guys, what is asked in question number 2 is related to completion stage of audit, where they basically ask you about, some evidences. Once again, procedures can be found here. Then even quality management can be here, like how to accept a client. You can find something related to quality management, or you can find something related to general theory areas. Plus, you can find something related to ethics also. Yes. Then question number 3 usually relates to other assignments. Once again, it's a mixture of procedures, reporting. You can even find other assignments. Other assignments are basically your due diligence, forensic accounting, forensic auditing, right? Prospective financial information. All these assignments are the other assignment portion where you can be asked questions. So review, reporting, all these things are important. So most important part of your syllabus is procedures. Second important is the planning stage of audit, where I talk about the risk. And third important is your review and reporting. Fourth important thing in your syllabus is ethics. Fifth important thing in your syllabus is the other theory, other assignments. And the sixth important thing is other theory portions. fraud, laws and regulations, quality management, my money laundering topic. All these are other last parts which are important. So this is it for my today's session, guys. And I hope it was helpful and fruitful for all of you, right? So I think that's it for the day. I hope it was a helpful session for all of you. And if you would have further doubts related to anything which we did today or AAA in general, please let me know. This is my WhatsApp number. You can text here. And I want to emphasize that in the coming days, I'll be coming up a video on the recent technical article which has been issued on AAA, plus some current issues which might be tested, right? And yeah, I'll share the answer that I've written in the class on the WhatsApp group. Don't worry, I'll share it. And about your further free sessions, the further free sessions are going to be for grand revision on all ISAs, grand revision of the syllabus. So that is once again going to be free on my YouTube channel. So please be there if you are giving AAA this time. You can go and subscribe to the YouTube channel by the name of Tashita Gupta, and you will find this video there tomorrow. Also, you will find the grand revision, like it will be in the first week of March, maybe around 4th of March. So we will have the full-fledged fast-track revision of all ISAs on 4th of March. Also, I am sure you guys must have seen the Super 20 questions. I hope you all have seen them for AAA, which I've given to my students, and I even made a YouTube video on that. So these are the Super 20 questions, these ones, and we will be solving these Super 20 questions in the class from 22nd of February, 6 p.m. to 10 p.m. If you guys want to join this, and if you guys want to give your mocks and assignments together with some question debriefs, recorded question debriefs, an important concept, like I really believe that in AAA, what is most important is the linkage between the standard and the risk and the procedure. So in our sessions, we have this time in the live sessions, what I've done is I've taken a standard, I've explained the standard from the SBR knowledge. Then I've talked about the risk associated with that standard. And then I've talked about the procedure associated with that standard. So if you want to take aid of these things, if you're already on the track of your preparation, no need to enroll because that would further confuse you. But if you need aid with regards to these questions and the important videos that I'm mentioning about the linkage of the standard, audit risk, and the audit procedure, then you can enroll into our crash course. So that can be found on the website. Let me just show you the website once, because some people are having issues. Since this is a new thing, so not everyone is able to reach out for this. So this is the website, and yeah, that's the problem. Anyways, so you can just visit the TG Prof's website and you can enroll yourself for the courses. Yeah. So these are the crash courses. You can find AAA crash course and you can enroll into that. So that's it, guys. I hope it was a helpful session. Thanks for being here till the last moment. And see you in the grand revision, maybe on the YouTube channel. And please, all the best. Take care. Good night. It was great to have you all here. And if you are here from any of my SBR sessions, so glad to have you here. Take care. Good night. Bye bye.